How common, how typical is earning the average stock market return? I've got that data and more coming up. My name's Mike Bernardo, the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So how common are common stock market returns? What are your stock market expectations? If you're sitting down with a certified financial planner and they've explained the markets and so on, and they might have said, yeah, I would expect this portfolio to average between 8 and 10% a year, or between 10 and 12% a year, or something like that. Dave Ramsey, as you know, says a good growth mutual fund should average 12% a year. It's a little more, that's an interesting take, okay? That's a bold comment. But you might have heard that maybe as you've done your own investment research, you've looked and said, okay, this should average X percent. Now, often I tell you, if you're doing your own research or talking to a less experienced financial advisor, they're drawing those percentage returns based on the past 5 years or based on the past 10 years. That's not a long enough time period to determine what an average expectation should be. And case in point is the previous 10 years. Right now, we're seeing some stock market volatility. The stock market, topped out in near the end of the year, October, November of 2021. We haven't seen an all-time high since. And so it's been, a year and a half or so. But that drawdown has been fairly common. And if you look back over the past 10 years, the only recession we've had is just the flash in the pan COVID recession. So I would say the past 10 years have been extremely abnormal. Therefore, I wouldn't take the experience of the past 10 years and extrapolate that forward. So you've got to look at broader data. But what are your investment return expectations? And then when you hear, that this should be the average return, how often should you expect that? Early in my career, I was serving some folks, still serving them today, and when they transferred their assets to us, we were doing financial planning, helping them retire, helping them pay down some debt and get the right cash flow, arrangement going. And I remember when we were talking about the investments, he asked me, okay, what sort of return should we expect each year? And I said, this level of risk, we should expect an average return of 8% a year, an average return of 8% a year. They transferred their money over in October of 2007. Did they average an 8% rate of return per year? No. We did fantastic and helped shepherd their dollars through the great financial crisis, and then beyond that. But for a while, we didn't average anywhere close to 8% a year. So therefore, when you hear that average, is that your expectation every year? Should that be what your investments, what your expectations are every single year? Well, let's take a look at the stock market. All right, take a look at this chart by DFA, Dimensional Fund Advisors. Great firm, great philosophy. I love this chart. Going back before the Great Depression, okay, that's important. So we've got nearly 100 years of history here. The stock market in those nearly 100 years, 97 years, it's averaged 10%. The stock market has averaged 10% over 97 years. I wish I could, I feel like I need a shirt that says that. However, in those 97 years, only 6 times has the annual performance been within 2% of that 10%. Positive 9 to positive 11. Within 2 percentage points of that 10% average, only 6 times. Only 6 times in 97 years. Therefore, without a doubt, you can have an average return expectation and know unequivocally that you're likely not going to have that experience, that return most years, or maybe even any years. And that can still be your average long-term performance. A couple other points to highlight here within this chart, looking at such a vast history here. Returns in any given year may be sky high, extremely poor, or somewhere in between. That will be your experience. That's not, as Kevin Korhorn says, that's not a bug of the stock market. That's a feature of the stock market. There is risk and reward. You can't have the reward without the risk. And so 54% upside was the biggest one-year return. And yeah, 43% downside was the greatest decline in 1 year. And we've had years where during the year, it was much worse than that. And then by the end of the year, things came back a little bit. Think 2008, things were down much worse heading, right before the election. And then really from the election to the end of the year, things got better. And then they got really bad from the beginning of the year into the early part of March 2009. So that's been the range of returns. But since 1926, annual returns have been positive 71% of the time, negative 26% of the time. And I'm not going to show you the chart that shows the stock market performance from 1926 until the end of 22 or until right now. But unbelievable as potential to build wealth and have unprecedented growth over that time. Again, averaging 10% a year. Okay, so how would I apply this data? Number one, the reminder that investing requires patience. Go back to the famous Warren Buffett quote, the stock market is a mechanism for transferring money from the impatient to the patient. Being an investor means you need to be patient. And we're 18 months into a time since we've seen the last all-time high in the stock market. Yeah, we're going to have seasons like this. We have no idea whether this will stretch on for another several years, whether we'll push through to new highs, maybe if we drop to new lows. We don't know. Stock market investing requires patience to deliver that 10% average long-term return. Second, I'd encourage you to take a look at your overall investment strategy and confirm that it's consistent with your financial plan and your financial goals. That you've got a prudent, long-term, diversified investment strategy, and then we would argue not only diversified investment strategy, but diversification of strategies. Because there are times when just diversification alone is not enough. You need more strategies in place that will complement each other to ride through the ups and downs that the stock market is going to give. And then third, I'd make sure that all of that, you're taking the right level of risk for your financial situation and your temperament. Because a fantastic stock market long-term return, 10%, if you aren't able to stomach that ride, then it's not an appropriate investment for you or for the majority of your dollars. So make sure that your investment strategies are sound and that they're taking the right level of risk for your situation, your financial goals. Work with your certified financial planner on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.